Hi, welcome to episode 8 of the Consumer Credit Matters podcast. My name is William Black, your host. In this episode, my special guest is Aaron Travis. Aaron is a serial entrepreneur and the CEO of a company called Karus, which is a cutting-edge tech service startup focused exclusively on the auto sector. And Karus stands out by providing advanced credit modeling and predictive technologies that help banks and credit unions and specialty finance companies basically improve their loan performance. So we're going to go deep into the world of auto finance and discuss some of the challenges and opportunities that the current credit environment provides, and just how Karus is leveraging technology to help lenders optimize their lending portfolios. So whether you are an entrepreneur yourself or a finance professional or just curious about the future of auto tech, this episode is chock full of a lot of great takeaways. I do hope you join us. And without further ado, here's my discussion with Aaron Travis. Thank you. Aaron Travis, how are you?
Good, Will. How are you?
I'm doing good. Great to see you. Well, listen, you have the distinct honor, I think, I'll call it honor, of being the podcast's first serial entrepreneur as the guest on the podcast, and that alone is, I think, fodder for some great discussion ahead. I'm looking forward to that, but I want to make sure people know your current role, your current entrepreneurial effort is with a company called Karus, and that focuses on tech solutions for the auto sector, which of course is just hitting on all cylinders right now, pun intended, of course. It's going to be hard for us to stay away from the auto puns. I'm afraid they're part of the vernacular, but it is just really just doing it phenomenally well. I think I was looking at the stats earlier. The ABS, the asset-backed securities market, is hitting, I think, 100 billion year to date. It did 140 last year, so it looks like we're on track to easily beat last year. And last year was a very, very active year as far as that sector goes. So there is a lot of auto finance activity going on. That's, of course, Karus's sweet spot. And we do want to learn more about exactly what Karus's angle is. And I think the other thing I wanted to point out at the top here is that after speaking with you, I realized your company is also on the ascendant. It is growing. It is expanding its customer base, and you've hit some really interesting milestones that I think will be of interest to other folks out there who are in the space, either entrepreneurial wise or just on the client or customer end of what you do. But I'm getting ahead of myself a little bit. Aaron, why don't we start a little bit? Why don't you introduce yourself? I'm sure I didn't do justice to your background, but why don't you give us a little bit of your origin story and how you got to where you are now as a co-founder of Karus?
Sure. So Aaron Travis, CEO and co-founder of Karus, and first half of my career was more traditional investment banking, New York and San Francisco. Within last 13 or so years, one startup after another, all focused on using data and predictive technologies for the financial markets. Some people might be familiar with what was varying degrees of success, certainly made a lot of headlines. I was an early founding employee at Circle Up, which was using machine learning, what you might call AI. This is early on, right? This is getting towards 2010, to try and predict which were going to be the next big CPG companies, having a credit and VC fund around that. Had some real failures, there's no doubt about it. It's not an easy path to take. Each one seems sort of like a tour of duty, and sometimes you come out with a medal, sometimes you come out a little bit dinged up. But probably most relevant to what most of this conversation is going to be would be a credit technology company called Random Forest Capital, which was acquired by a major mutual fund complex. And that ties into the origination story, which you mentioned for Karus itself and auto. We were predicting defaults, call it, and buying notes from the big marketplace lenders, Lending Club, Prosper, SoFi, Upstart, all the folks that we know and love. And a lot of those unsecured consumer loans, the stated reason was for an automobile purchase.
Right.
So here you have this consumer credit market, or a piece of the consumer credit market that's traditionally asset backed, unsecured. And the data was fascinating and the performance was fascinating. So that's sort of the origins of sort of how I got interested, or how we got interested, I should say, the team, in consumer auto. And about 3 years ago, we looked at sort of unsecured consumer. Do we want to build something there? Or consumer auto? And we said, gosh, unsecured consumer, I think we could rattle off 30 folks that are
Right.
public.
It's crowded.
Well, auto, it's really difficult. It's difficult to really even rattle off a singular one that's solely focused on it. Usually it's a portion of, say, Upstart has their auto efforts, or Pagaya, and there's a consumer credit fund out here in San Francisco called Theorem that's gotten to some size, participating in auto. But we said, let's get our hands on some data sets. Let's build some models. Let's compare those and back test those to some of the incumbents. We said, there's some inaccuracy here. There's some room for us. So that's the origin story.
So, you were very data centric from the get-go. You were oriented around the consumer from the get-go, albeit in a different lane than you ended up in with Karus, right? You were personal unsecured. And so you said, look, we think we understand consumer credit behavior, or what we do understand, given the analysis of the data that we've had in personal unsecured, we can extrapolate from that into the auto sector and create more alpha in a less competitive field, at least for now. Is that a fair wrap up of your?
I think that's fair, but let me call out here early on in this conversation sort of what I might consider the elephant in the room, especially for people that might be listening to this. The using a lot of data in predictive technologies, ML, AI, great data science team, which we have all of, 1,000, 1,100, 1,200 features for each borrower, being better at credit is really sort of what you might think of as table stakes and ubiquitous. So many folks are doing that. I think they do a decent job at it. When you think about having higher performance, or if you're an asset manager delivering alpha, describing it that way, you have to think about the entire transaction, not just the credit piece, because you're not going to get that outperformance just by focusing on having better credit models, say, outside of FICO. And I know that's a bit controversial for someone like from someone like me to say, with my background, or even what we're building here at Karus, but I truly believe that. And so we can dig into this a bit more, but what I mean by that is, what do the acquisition channels look like? Where are these borrowers coming from? Where is the collateral coming from? What does data integrity look like, which gets really interesting in auto relative to some of the other consumer credit markets? And then on the back end, what does servicing and collections look like? You know, that everyone in consumer credit calls that a commoditized type of a product or service, which I really disagree with wholeheartedly. And then I'll mention one last thing: the pricing to the dealer or the retailer in auto, another unique feature. One thing that we had done that was a unique feature at Random Forest Capital in the unsecured consumer is we had put our servers close to the servers of the different marketplace lenders, so that when we saw a loan we liked, almost like a high frequency trading type of contract.
You were close.
With auto, if we can more accurately predict what Capital One or Ally or Westlake go through, all, there's a lot of competition. There's hundreds of them. You can more accurately predict what their offer or callback is going to be to the dealer or the retailer. That could be online, of course. When you find that borrower and that collateral that you would like, that you think is going to deliver that alpha or outperform, how do you pay up for it by the smallest increment to win it? So this starts to get sort of really interesting as to what you can build outside of just, hey, Will Black, I am looking at 1,200 features. I'm looking at his trending credit features. and trying to figure out what his default problem. Are we doing that? 100%. Do we spend a lot of time and collect a lot of data to do that? Yes, we do. But it's the combination of all those things that really allow you to originate higher performing receivables.
So Aaron, maybe we take a quick step back. I think that by the way, that helps a lot. That's a great context. And I do want to definitely come back to machine learning, AI. It's a super hot topic. It's come up in all of my conversations in some way, shape, or form. So we'll definitely be coming back to that. But maybe just a level set for people who may not be may not know what Karus does. Can you explain that in kind of simple, high-level terms? Who your customers are, what your service is. Maybe that would be a good way to level set.
Sure. So the credit modeling that we do is all focused on a cash flow type strategy. So an individual loan, we're trying to predict the cash flows on that, or at the portfolio level, which is a related but somewhat separate business for us. We'll get into that a little bit later. But to really sum it up in a simplistic way, some of the tools that I sort of described there, including the risk-based pricing, the credit models, it optimizes auto lending for our customers. And so that could be the last place we'll probably try and dig in is on the OEM captives. But that could be, of course, a bank, a community bank, a credit union, an auto dealer group. A lot of dealers have their own captive lending. And then there's a whole host of specialty finance companies in the industry as well. So whomever might be extending an auto loan to an auto buyer would potentially use our tools to optimize what they're already doing. Our favorite customers are the ones that are excelling and performing well, as opposed to you would think, well, wouldn't you call Karus if your delinquencies were high and your charge-offs were high and your pricing was off? The answer to that is yes. We want to improve performance for any customer, but we also love the fact that we work well with lenders that are performing well and want to perform even better, and other metrics like conversions and win rates and acquisition channel work. But I'll stop there.
So no, that's helpful. That basically you're saying you can provide.
Here's a great use case that everyone can kind of grab onto. And this one is a specialty finance company. Was having issues with performance of higher loan amount loans. So call it anything that was over $20,000 loan amount. Their delinquencies and charge-offs were higher than the rest of their book. That would be something that we came in and course corrected with them and for them.
Mm-hmm. So, but I guess what I'm saying is that you're dealing with, it's B2B. You're dealing with companies that already, if I were to sit across the table from them and say, how are you underwriting? They would tell me, our underwriting is second to none. We're doing great. But there's always room for improvement, as you and I know. And so that's where kind of Karus's expertise comes in, is like, we can provide lift where you don't see it, or you can't achieve it. And that's the value add. That's the value proposition of engaging with your company, correct?
No, that is correct. I mean, we look and feel like an optimization type vendor, not like a replacement of your underwriting. Now, do we allow for, which is, it might be shocking to some of the audience to hear this, there's still a lot of advisor pencil manual underwriting happening in auto. So there's an automation and speed piece to it as well. But for the most part, we look like any one of their other vendors. So if they were using the work number to validate income, and now they want to use something more specific and more powerful like Plaid to look at what's coming in and out of their bank account, when they think about any of their vendors for credit risk modeling, we would be one that helps them optimize, and I know I keep going back to that word, optimize what they're already good at. We have one customer that has an underwriter that is particularly better than all their other underwriters, has a higher conversion rate, higher win rate, which usually when that conversion rate goes up, performance goes down because you're booking more loans, volume, you're usually widening credit to get that volume.
Right.
Not only is his conversion rate higher, but his performance is better than anyone else. So a lot of what we built with them, and I probably should explain this, we have what we call a layer one set of data, which is tens of billions of auto outcomes in our own modeling that our data science team has done around decision, loan structure, pricing to the dealer. Then we take our customers' own data, their own point of view of credit, anything they may have done as far as modeling, and we mesh those together for something that looks customized to them. And then it's constantly being iterated on. So there's something called the Karus portal, which allows you to visualize all your lending in these looker type dashboards. And so we're watching, or they are watching, it almost looks like a CFO tool, watching their lending program, all the apps coming in. What are they declining? What are they approving? What are they booking? What do the payments look like that day? And what needs to be optimized, and getting on the phone with our data scientists. So when you think about one of our launches, that first month, we might be on 10, 15 times that month, toggling default probabilities, LTVs, PTI. Once the program gets going, those iterations, become farther and farther apart, but they never stop. This is not a black box model that you just ping and trust it.
Right. So yeah, it sounds very hands-on, certainly in the beginning when you're trying to integrate your systems with theirs, and you're leveraging your proprietary databases and expertise and algorithms with theirs. So you're kind of supercharging, the best of them, or identifying some of the holes in theirs with the best of yours. And that in terms of the algorithm decision making, is that and so that in just operationally, that's got to be a fairly heavy lift in the beginning. But once you work that out, once you've worked out those, I'll use the word syntax differences, once you've created those definitions and the two systems can talk to one another, your customer is left with a user interface that they can use to run and manage the business. And that's your proprietary software that you're basically that you're monetizing.
That's correct. So you're 100% right. I'm not going to candy code it. It makes our business maybe a bit more hands-on. So we look like a combination of a out of the box technology and sort of consulting. So we sometimes look and feel, and the sales process can be really tricky, right? For these really critical mission software products, sales cycles can be long, and they can also be tricky from the perspective that it's a big deal. It's not like they're trying to decide between NADA and JD Power vehicle valuations, which tend, that's a small choice. So having said that, though, Will, our customer success and our interaction with our customers is going to be probably a bit more complicated than perhaps some other lending SaaS solutions out there. Hopefully that makes it more sticky as well.
Right. I definitely see that. I can only imagine. I mean, once you've gone through, the early stages of that process, then there's definitely some stickiness there, particularly when you're adding value at that point. So you've got this nice kind of software package that provides value, relatively early to your customers. I want to spend a little bit of time just talking about the customers again. I know, this is it's a huge market. I think you went through them very quickly, but you said indirect lenders. But I imagine that your universe is bigger. So you are working with banks, credit unions, and finance companies, to be clear. Is that true? Or why not, right? That's anyone who could, who wants to make their underwriting decision engine better would be interested in speaking with your company, right?
No, that's correct. There's really not a type of organization, and we just launched this summer with our first credit union. So, we went to market last year. So we're less than a year into it, just so that everyone knows where we are in the cycle. So we're early on for sure. But anybody who's extending a loan and has an underwriting infrastructure, one of our customers, it's a great example, has their set of dealers that they lend to in about 3 states. They want to expand to 2 other states and swim up the credit spectrum a little bit and not hire any more underwriters. So our technology allows for all of that, in addition to a lift in performance, which our performance data is just starting to come in from our first sets of customers last year. So far, it looks good. So that's great. Hopefully that helps us with our traction and acceleration, because as you can imagine, you can back test till you're blue in the face. Everyone wants to see real results, real performance metrics. So the other thing that's been interesting as far as swimming upstream from the size of customer perspective, which is just starting for us, is last quarter we launched that Intex auto ABS forecasting business.
Well, that's huge. Let's talk about that, because I mean that is a very big milestone for you, I would imagine. So maybe you can explain that to folks who aren't familiar with that.
Sure.
Congratulations, by the way. That was huge.
Thank you. Yeah, that took some time, and it went through a massive diligence effort, as you can imagine. But essentially, the leading structuring tool for ABS markets in general, not just auto, is a product called Intex, which a lot of the audience may already know of, and that's on every major buy side. The folks that are buying the bonds, the issuers that are issuing the bonds, the lenders, right, and then the investment banks.
And some rating agencies, as I understand.
And some rating agencies as well, yep. And Karus now is the only auto ABS forecasting partner on Intex. So those Intex users will see our logo up there. If they want to turn it on or get enabled, they pay us a licensing fee. And essentially, really simple way to put it is they get a default curve, a prepayment curve, and a severity curve from Karus, and then Intex does all the heavy lifting in creating the cash flows, so they can decide which bonds they want to buy or sell.
Now, so this is a big deal because, I mean, as you said, Intex is kind of the most well-known and used platform out there for this kind of securitization data, and I would call it forecasting tools. I'm not sure you would use that same term, but I certainly, that's how I think of what most of the market uses it for. And so because you're focusing solely on autos, you become a specialist in autos, and that allowed you to become the preferred vendor for them, in a sense, for providing the tech or the overlay to their data sets to help drive forecasting engines for their customers. Because they have other third parties that they work with for the other different asset classes, right? I think they've used different companies to provide the tech for the forecasting tools that the industry uses as an overlay to their data engine. And so you were chosen, Karus was chosen to do that for autos.
That's correct. And I guess you have, if you're a user of Intex, yes, Intex is, you're doing the forecasting on Intex, but you're using your own inputs if you're not using a third party. And before Karus was integrated with Intex, you had no other choice but to use your own inputs. So that was the diligence process I referred to. We had to show Intex that our forecasts or our ramps, if you referred to as ramps or vectors, had accuracy. And so that's one that is one area of sort of modeling where back testing can be a bit more powerful, because we could go back at the point of origination on older securitizations where the outcomes and show exactly what our models would have forecasted. So back testing, I don't know if I want to call it, it has more credibility in this sense. So that was how we were able to get approved and get onto Intex. And it allows us to talk to much larger participants, lenders, and originators in auto. So we get on with their capital markets team. Think about your serial securitizers, sort of household names for probably everyone listening to this, and you get on the phone with them and say, do you want to see what the buy side is using for a default curve and a prepayment curve and severities on your next deal? Because we've modeled it out.
Right.
And then can we talk to the underwriting team? Can we show you some of the tools and some of the data that might be helpful to you and your team? Now, if you were to go into a Santander, Capital One, Ally, and say, hey, I have a great underwriting tool, you should institute it across your auto lending, you're going to get laughed out of the building.
So you're squarely in. When I think of startups in the auto space, they kind of fit into, again, I'm overgeneralizing it, but into two buckets. You've got your tech servicers, which I would put you in that bucket, and then you get your balance sheet lenders. So you're squarely in. You would see yourself as squarely in the tech servicer bucket at this point in time?
I would.
Yeah.
Well, everything that I'm describing, all the lending programs we've helped optimize, some launch, the dozens, if not hundreds of others that we've done deep analysis on through our sales motion in trying to get these folks, everything we've seen in the last 3 years, all the data, all the integrations that we have, and all the expertise, domain expertise we have as far as, let's just use income validators, which I mentioned a couple of earlier. We have a pretty strong viewpoint on what works, when it works, and what channels it works in. Having said all that, I just set the table where we feel as if being a fintech balance sheet lender is something we could be really good at.
I've got to imagine that's rattling around in the back of your mind, because you've got the expertise, right? And and you have confidence in your ability to execute, and that's clear. And you have a track record now, right? So all of those are kind of more than many balance sheet lenders who startups have had. So I that thought did occur to me, but so obviously,
and I'll say one other thing, going back to sort of what I think of as a little bit of a controversial statement in the beginning of the conversation. You notice there that I didn't say we can price credit and we're better at credit than everybody else.
Mm-hmm.
Even though we spend a lot of time and resources, data science, data, and yes, I'll go back to, yes, we're very focused on it. We think that we're good at it. We think we're going to continue to get better. But if you look at some of the folks that have not fared well in this space, in having their own balance sheet, in using MLAI and credit technologies, they really sort of focused and thought that the silver bullet would be, and it didn't end up being exactly what they thought. So I can't say that we're smarter. We just get to look at what they did and say, all right, what are the other parts of this that make you a successful lender? And I'll say this one other thing, because I'm going to go ahead and ask myself a question here, Will. If you did have your own balance sheet, your current customer base, would you then be competing with them? And then would you not be able to get other enterprise SaaS customers? Because now you become competition.
Right.
And a great example is Westlake, the behemoth, who now sells tools and servicing throughout the entire industry to all the specialty finance companies. And the fact that Westlake has liquidity and can buy notes is a massive positive. So almost across the board, any of our current customers or any customers that our prospective that we're talking to, if we had our own balance sheet and the ability to buy notes or originate, pretty much across the board is a positive.
Yeah. I get that. Yeah, that makes sense. And that's a great example. So you mentioned AI again. I did want to come back to that because, again, it's a hot topic, and everyone uses the word machine learning, ML, or AI differently. it's probably not very controversial a statement to say that it's going to have a relatively quick and call it pronounced effect on some of the operational aspects of consumer credit operations from an operations perspective. I think when we started to get into underwriting and lending, it becomes more complicated quickly. If you trained your model on a large language model, if you're using a large language model to help make your algorithm, your decision, your underwriting decision algorithm better, I have no doubts that that is doable. But the question is it going to pass the regulatory hurdles that you need to pass, or your compliance hurdles that you need to pass? And how are those frictions being dealt with? And I'm not sure that Karus needs to deal with those or your customer needs to deal with those, but it seems like some degree of transparency as to what and how AI is being used and how you can explain what it's doing has got to enter the equation, enter into the dialogue here at some point. Maybe you can help us understand how that friction is overcome, or at least mitigated.
Yeah, overcome would be a strong word to use, and I don't know if that's ever possible.
Right.
Mitigation is probably a better descriptor. So a couple of things here to unpack. The one is that to take human bias out and using a machine does take human bias out. Okay, great. That's one topic. Everyone gets that. However, disparate impact, which refers to inadvertently being biased towards some group.
Right.
The way that the models are coded or the way that the models have been built can be built to not have any bias. But from the regulator's point of view, even if it happens by accident, you can get yourself in trouble.
Yep.
So there's some third party, actually there's some third party, once again, AI companies popping up that sort of validate the models for disparate impact. We've been talking to a few of those. We haven't sort of partnered with one. To your point, it is a little bit of falls on our customers, since
right.
They are the lender of record. Now,
right.
If we were to have our own balance sheet, falls on us.
Yep.
But also, as you heard me describing, we're a pretty close partner in what their underwriting and credit looks like and how it's being built.
Yep.
So, man, it is such it's a difficult issue. You can only try and mitigate it as best you can. And as of right now, the way that I would describe it, Will, which isn't a great answer, I don't know if anyone has, you got to have a great law firm. And a lot of it reminds me of some of my past sort of work in public markets in the SEC. It's sort of show us your process. We can see that, you inadvertently were biased against this group here. Show us the process you had to try and catch that. Okay, here's our processes. We were very deliberate about them, and we were very active with them, and that fell through the cracks. But I don't have a better answer than that right now.
Well, it brings me back to, a time, this is probably about 8 or 9 years ago, I'm going to estimate. I went to a conference. It was then called the Lend It conference. I don't know if you're familiar with that.
Yeah.
So I used to attend that, and it was here in New York that year. I was really blown away. It was very exciting. I'm sure. Actually, I think they stopped having it this year, if I'm not mistaken. But it had a very good run. It was a pretty well done. It
was fun
conference. But in any case, in those early years, there were a lot of people getting on the stage, entrepreneurs, who were on the bleeding edge of technology and its use. And they had fancy slide decks about how they were using alternative data to improve underwriting back in those days. And nobody talked about AI then, right? But certainly they were talking about machine learning and some of these, screen scraping technologies that they used. And I remember one guy I don't know why this stuck with me, because we know how long someone's mouse pointer is hovering over this decision or that decision, and that will that conveys a certain meaning to the risk profile and so on. This type of thing is like, wow.
I remember that.
And then, so I was wondering out loud back then, I was wondering, where is this going to go? This is it seems incredible. The sky's the limit. How refined can this get? And then the next year or the next couple of years, again, same conference or same kinds of conversations, all of that went silent. Nobody talked, and it was because of this topic of bias, and using alternative data attracted attention that became, I won't say indefensible, but became another level of headache and difficulty to scaling up. And so I don't know, honestly, I don't know where those types of techniques are today. Maybe they found a path, for all I know, but I do know that what was being kind of trumpeted loudly on stage soon became not even whispered about in these types of settings anyway.
Yes.
So it's kind of technology got ahead of itself, right?
Yeah, I remember those techniques and how someone filled out, how long it took them,
right?
Whether they came back, feeding that all into a default type model. We did that at Random Forest Capital for sure, and we were at that Lendit conference every year. It was fun.
Yeah, well, maybe I heard somebody from your company on the stage. I don't know, but it is fascinating, and I think the use of AI, large language models. You're making decisions on, and if I believe what I read about it, is millions of parameters can be used to train those models. It is by definition, though, something that is out in the digital domain. And so you're automatically your database on which you're training your models is biased by the people who have a digital record and skewed by how that digital record is populated. So some people aren't even, believe it or not, well represented in the digital domain, or some people are overrepresented on the digital domain. And so again, you don't have to take leaps of getting into kind of nefarious intentions here. It can just happen by the mere fact that the database on which you are referencing or looking at or training your models is already biased in that sense. And so you have to be real careful, because at the end of the day, I think the regulators are certainly focused on how you arrive at your decision making, but they're obviously also focused on the ultimate decisions that are made and how that looks in terms of the demographics thresholds that they're focused on, right?
Yeah. So you're making me think about something that I mentioned in the beginning of this conversation: acquisition channels. Mm-hmm. So when I think about one of our peers that's been tremendously successful, been some headlines about them potentially doing an IPO, auto-focused. And I don't know if they made their decision or their strategy in this way, but they found a group of borrowers of which there's very little data and lenders didn't want to lend to. But they're not necessarily because they're lower on the socioeconomic ladder. These are expats from foreign countries that tend to be or can be or are wealthy and well-resourced, just with very little credit data here in the U.S. So they go out
thin file.
Yeah, what you would think of as thin file. They go out and they grab from their home countries the data.
Yep.
And so they're funding they're doing auto finances, and the performance has been tremendous. The growth has been tremendous. So and yes, they're using predictive technologies like we are, like a lot of the peers are. But there's a great example, Will, where thinking about what your market is, who your borrower is, could be just as, if not more important. These credit models are your engine. You take a great engine and you put it on the wrong chassis with the wrong wheels, and you're going to go off the road.
Right. Okay. Why don't we move on from AI? I think that was really helpful. Thank you for those war stories and those anecdotes. That's very interesting. Maybe another angle I think that would be of interest. Can you tell us a little bit about how is Karus funded, and how is it funded? How has it been funded? We all know these are very difficult times for any startup, just because financing is not easy to come by, and when you can come by it, it's expensive. So the days of lower for longer, the decade, actually longer than a decade of lower for longer, that very long on-ramp that produced hundreds and hundreds of startups, it was really a remarkable, I think we're going to look back at that as a remarkable time, is probably not going to return anytime soon. And if we get lower rates, we're probably going to get slightly lower rates in the near term. But if we get really lower rates, it's probably going to be for reasons that we don't want those lower rates, right? Because of addressing kind of a recessionary scenario or something like that. But I'm not going to get into the forecasting business here of interest rates. But maybe you can comment a little bit on how that part of running the business has been, just as kind of a lessons learned for other folks who are trying to do similar.
Yeah. So this is not going to be a surprise to anybody. We're VC backed.
Yep.
And some great angels. Last 24 months have been challenging and difficult. So there's been an extreme focus on efficiency, which probably isn't bad for the whole startup world or in general for capital allocation. I think things got maybe a little too loose. I think we all know that across the board. Whether you're talking about IPOs, credit, venture, things got pretty loose there up into the crescendo of the last cycle there, up into that first quarter of 2022. And then what happened was on the good news side of it, basically our investors, our advisors, our board, ourselves, and this was happening, I think, across the landscape. It was kind of focus on unit economics, focus on revenue, focus on path to profitability, and run the business as if you don't have just an open war chest,
right,
to get to where you need to go. So unfortunately, we here at Karus missed the big, huge, rounds that hit at those huge valuations in 21. But hopefully, coming out of all of the other end of all of this, we end up with a much more sustainable, profitable type of business. But it has forced you to be extremely efficient, to have a team that truly believes and is willing to sort of put in that extra effort, which any startup has always had. That always exists. No doubt about it. It's at a heightened level, or has been at a heightened level for the last 24 months. And you really have to think about strategic investors that can drive the success of your business now much more than you did before, because because there's not this unlimited amount of funds out there that you can always sort of grab to save yourself. You really have to make sure employees, investors, partners are all really aligned and all working together to make it a success.
Got it. Thank you for that. And maybe another quick topic to run through is your take on the credit environment. I'll just give you my 2 cents on this. Is depending on where you decide to focus your attention. I'm talking autos here, auto lending. Prime is doing, as you would expect, quite well in terms of the credit performance. Subprime, however, not so well. Broadly speaking, has has underperformed relative to the macroeconomic context. At least that's my read. And it has been underperforming for now going on a couple of years, which is somewhat surprising, particularly given very, very low unemployment rate, just a solid labor market, which is probably the top macroeconomic indicator for loan performance. And it's been, again, the people I speak to in the business, it's been a little bit of a mystery. I mean, we can all come up with reasons why we think that might be, why there might be this sometimes referred to as a tale of two cities, very divergent kind of credit behavior or credit performance experience going on. But nonetheless, I think you do see some folks somewhat surprised by the level of disparity between the two groups. I would think of that as an opportunity, as a good kind of context for a Karus to kind of come into the picture. But let me stop there and see what your take is. First of all, in the credit kind of context, maybe you can even let us know if you have a view on what the near term performance is likely to shape up to be, and also what this means for your business model.
So let me step away from my serial optimism and I'll tell you what kind of concerns me a little bit or worries me. Then I will tie that into, hate to tie any duress into an opportunity for Karus, but I'll do that.
Right.
Watching what's happening in the subprime, which the vast majority of the over $3 billion loans that have come through Karus and been processed by Karus are in the subprime sector. As you can imagine, having better credit models, better risk-based pricing has more value in the lower part of the credit spectrum. I think that's an obvious statement. But one thing that's interesting that's happening here in this country, I guess I'm not even sure if I could say global, but in this country, the tale of two cities has always been, it's kind of been part of human existence, to be honest with you. But right now, with unemployment where it is, the real problem is that they can't afford to make these payments even while being employed.
Right.
So they're just stretched too thin, and we can blame it on inflation. And I mean, I guess that is really the blame. And also on the just much higher costs of living across the board, and especially the higher costs of owning an automobile and, of course, purchasing an automobile. So one thing that I do think, though, is happening to sort of mitigate that a little bit is that lower cost automobiles are becoming a little bit more in vogue. I sort of marveled at it myself, where I thought, man, when I grew up in the 1980s, someone who had a Mercedes-Benz was wealthy. Now, man, everyone's driving around in $60,000, $80,000 SUVs, and these luxury priced cars for a little bit there sort of became commonplace. So there's other ways to mitigate those monthly payments other than just making more money at your job. So I feel like we are seeing that in real time. So the loan amounts are actually decreasing. Used car values, Manheim used car index has gone from about 250, 255 at the height there. I think it's at about 195 now. Mm-hmm. So it's come in significantly. That's super important for recovery rates. So if you were lending against a car when it was up at 255 and you have to repossess it and go sell it, and now that automobiles depreciate as is, and then you add that the overall value going down, it can really affect recovery rates and have a big effect on returns. But I'll end this with how this dovetails into an opportunity for Karus. All these moving pieces that I'm describing, it becomes a little bit more difficult for rules-based or human-based underwriting to pick up on these trends as to where you should be lending, not only in the credit spectrum, not only geographically, not only from a collateral perspective, but also from something like a loan amount perspective, which I mentioned earlier in the call. There's a lot of different metrics that you can key in on that help you have a higher performing portfolio of auto loans.
Okay, so that's obviously a place for the Karus product to add value. Yeah, I mean, I share your concern about this. What I don't know, paper thin margin that the non-prime segment of the market seems to be getting by on. And it is, it's funny because the other side of inflation that doesn't get as much headline press attention is wages, salaries, income, which have in fact come up. I mean, they have actually stayed ahead of, again, macroeconomic statistic wise, the core CPI rate. So, and maybe even more so for the lower tier income brackets. So it adds to the mystery of how is it that, yes, costs have gone up for sure, costs of borrowing, costs of goods and services, but if incomes are keeping up or even doing a little bit better than that, and we haven't flung ourselves into kind of a wage price spiral, which would be horrible, it seems like we're avoiding that, then why is it that we're seeing borrowers struggle so much? Again, a mystery to be solved for another day, but it is it's a bit of a head scratcher, and it does. And maybe this is what you're thinking, is what I'm thinking anyway. Is that, boy, if this is happening in the good times, where people have jobs, who want them pretty much. What happens if the economy takes a turn for the worse and we have unemployment, up a couple more points from where it is now? And something I've got my eye on as well. The unemployment rate has ticked up the last, I think, 3 consecutive months now at 4.1. Still very low. Solid employment on almost all the other measures that you can look at. But these are the types of things that, what's the saying? It moves very slowly, then all at once.
I went bankrupt very slowly and then all at once. Yeah.
Yes.
But that's one way to say, yeah. I hear you. I don't know if for the lower income folks, if CPI, when you look at the CPI, great, it peaked, at 9 for a month or two. So if you look at the last 3 years, what did it average? Maybe 5. So you're telling me that my grocery bill went up from 100 to 105 to 110 to 116? I mean, that's not what's happened, Will. Not even close. It's much higher than that. But getting back to sort of predictive technologies, credit, and strategies for credit, the other thing that this brings into focus is the importance of having a different type of default probability or credit score for each transaction, because a lot of these borrowers now are having to decide. Someone becomes unemployed, they stop paying their bills. They're employed, they pay their bills. They're stretched, they make a decision.
Right.
Do I pay my student? Do I pay my medical? Do I pay my mortgage? Do I pay my auto? I have 3 autos. Which one do I pay?
Yep.
So we feed that into our models on the auto side. So you might have the same borrower with 3 different types of collateral, and one might be priced at a 750 FICO, the pickup they use for work. One might be priced at a 650 FICO and one at a 550 FICO. Maybe the convertible Mercedes that they go cruise around on, that might be the one that they stop paying on first.
Right.
So these are things that our data scientists / credit analysts are thinking about all the time. And this type of dynamic we're in right now makes it even more important.
Yeah. And that's another good part of what you do, what Karus does that is evergreen, and that is the world of consumer behavior, because it's made up of humans, is ever changing. And so the algorithms that you use today, they become stale pretty quickly. And that's particularly true when you add intense competition to the mix as well, right? Because everyone is trying to pick over the same, prospects, put it that way. So, Aaron, this has been great. I do want to ask you kind of in closing, maybe a question, an open-ended question around your experience. Again, as a serial entrepreneur, someone who's started several businesses now and has just, I guess, loads and loads of experience and wisdom to impart. Maybe you can close by just maybe talking a little bit about some of that wisdom, sharing some of that wisdom with listeners about what it is that you found is kind of the take-home guiding principles that you've learned over time that would help anyone in starting out in any number of entrepreneurial endeavors.
Yeah, sure. So I'll kind of leave out all the sort of cliche kind of team culture, product, those types of things that are all just obvious.
Right.
I will say this, especially in the environment that we're in, that's come about in the last couple of years. Really waking up each day and having yourself and the team focused on what are we building that someone will pay for, and then what are we adding to what we build that someone will pay for, and trying to thread the needle of between product build and customer launch. So you can spend a lot of time building bespoke things for customers that are not going to translate into other customers. So you have to be really careful there. Then you can also spend a lot of time building a product, building a service and/or product that you think is exactly what the market needs. Pick your head up after a lot of time and resources and realize you were off the mark. So think about that sort of, think about that that middle road there, where you're incrementally building for customers based on what they want, but also thinking about getting that product to a certain point without going beyond where you've put yourself in a position where, and I see this over and over again, and I've done it myself, and I'll probably do it again, where you spent a lot of time and money building something that you'd be damned if the entire team wasn't sure it's exactly what the market needed.
Right.
You picked your head up too late.
So deliver monetizable value add and stay focused on that every single day.
Yeah.
Yeah. Great advice. Great advice. Aaron, been very generous with your time. Thank you very much for spending some time. I'm sure this is going to resonate with listeners from all stripes and backgrounds. So really appreciate the time that you spent with us today. Thank you.
Thanks, Will.
Thanks for listening, everyone. Yep. Take care.